Hi, welcome to this video today, which is all about learning from a millionaire Forex trading strategy. And the strategy we're going to look at today is one of the most famous of all time. It's the turtle trading strategy, made over $200 million in real-time profits. And I put a PDF with all the rules and logic of the strategy beneath this video. So you can just download the PDF. Now, in terms of the turtle trading rules, will they work today? They won't work like they did back in the 1980s because market volatility has changed. But the basics of a winning trading strategy are in that PDF. So what we're going to do is put together a trading strategy you can make money with. We'll go through some key points. Now, in terms of Forex trading, we know that a lot of traders have a problem cutting losses. That is a problem for a lot of traders. Personally, I find that the easy part of trading. The hard part of trading is running profits, holding your profitable trades without banking early. And you've got to put a strategy in place that will allow you to run big profitable trades. Now, in relation to this, there are psychological biases we're all subject to, which make us want to snatch profits. And when most traders put together trading strategies, they don't really appreciate the temptation that comes into play. It's just in our psychology. Okay. Also, when they put their strategies together, they ensure that they're not going to make money with the strategy because they don't understand the phenomenon of big data, which is a real problem today. So I want to go through a strategy that basically can help you overcome the problems that big data will give you in the markets. Okay, it'll all become clear as we go through the video. Now, first of all, what I want to do is just go through psychological problems we have in terms of money. I just want to show you a very short clip. Some people are asked two questions, okay? And I would probably bet that most people watching this video would give the same answers, okay? Now, in terms of the two questions, first answer, totally correct from the people who are asked. Second answer makes no sense whatsoever, okay? And you've got to understand it when you trade Forex. Okay, here's the clip. It's only about 45 seconds, then we'll be back to discuss in more detail.
We asked shoppers in a Chicago mall if they would prefer $100 in a year's time or $102 in a year and a day.
I'll take the $102 in a year and 1 day.
$102.
Year plus a day.
And then I can wait that extra day for the $102.
Yeah, for extra $2.
Yeah,
it really will make me a difference.
Yeah.
I would do the 102 a year and a day from today.
They all made the rational decision.
What's 1 day after a whole year of waiting?
And chose the larger amount. Then they were asked if they would prefer $100 today or $102 tomorrow. The larger amount is still the rational choice. So what did they say?
Oh, I'll take the $100 right now.
I would take $100 today.
I would prefer the $100 today.
Today.
I'm taking $100 today.
The desire for a quick reward
$100 today.
trumps their rational self-interest.
There's something called present bias, that if we have the option of something right now, it's very tempting to go for it.
Hi, welcome back after that short clip there. Now, I think the lesson is pretty obvious. We all have that temptation to want to get a profit now. Okay, now it's not just to do psychologically with wanting the profit, particularly in Forex trading. It's also to do with another factor that comes into play that really makes traders unable to basically follow big profitable trends. And it's related to what's called prospect theory. Any trader needs to understand it to make money in Forex markets. Now, we're going to look at prospect theory and also putting together a strategy. And basically, when putting together a strategy, you need a strategy that can combat your psychology, so you do not snatch profits early. And that strategy, you understand why it's going to make profits longer term. Now, in terms of big data, I mentioned that earlier on, it's a huge problem in basically distracting traders in terms of what they really need to do to have a profitable trading strategy. So what we're going to do is go to a storyboard and go through some key points in terms of putting together a winning strategy. All right, let's have a look at how to build a winning trading strategy. Now, we did see earlier on a problem for people is that if they are presented with money right now, they want to take it. You saw it in the shopping mall. Yeah, why not wait for the extra money? You know you're going to get it, but it's wanting to take the money right now. Now, that obviously comes into play in Forex markets. Trader has a profitable trade. It looks like, yeah, the trade is going to continue in the way that the trader wants it to, but they're just so tempted to snatch the profit before it gets away and just minor retracement or just bank it out. And most traders have a problem holding big moves. Okay. Now, another problem that comes into play comes from prospect theory from Daniel Kahneman, a Nobel Prize winner. He worked out that we fear losing more than we like winning, and he proved it with numerous psychological tests. I won't go into them here, you can look them up online, but we are extremely risk averse. We really don't like losing, and a lot of traders, when they put on a trade, they may only even have a very minor profit, and it looks like it's going to continue again. It just turns a little bit. They fear losing so much they'll close the trade out, put their stop to entry, which is a huge mistake. So you've got to learn to run profits, okay? And yeah, in terms of doing this, we'll come back to it in a moment. But just want to go through market noise. That's increased dramatically in recent years. Okay, so when the turtles traded, trends were much smoother than they are today. There weren't so many retracements or such deep retracements or so much noise within the trend. That is another problem that traders have to overcome. But most traders will not overcome the problem because they believe in big data. They won't even know what big data is, but it causes them to lose money. Now, big data is basically just analysing data, okay, and statistics and all the rest of it. And to give you an idea, in the world today, we create 2.5 quintillion bytes of data each day. 90% of that is created in the last 2 years. And in the Forex markets in particular, there is the view that that big data can really help you make money from price action. And in terms of what you're going to see, just take if you looked at 24-hour or looked at a 24-hour news channel in finance, they will explain every small move in the markets. You might get a 30 pip move in a Forex pair. It's instantly explained by some bit of data. But only after the event, that move was probably just random. Yeah, they're looking at too small time frames, okay? Now, in terms of computer testing and analysing data, that's huge as well. Traders want to develop mechanical trading systems that make money. They'll run tests over back data. They will then fit a strategy to that data. Okay, it's called curve fitting, and it will work. Then when they trade it in real time, it doesn't work because price action doesn't evolve in exactly the same way going forward as it did in the past. Okay, that's another major problem. Okay, now the common error that traders make is they want to trade for short-term moves. Okay, now what they're really doing is trading the noise, but it's easier psychologically, isn't it, to aim for short-term moves than big profits. So you'll see traders looking to make 50 pip profits regularly. They want to focus on as many winning trades as possible. There's plenty of people online who'll say this is a good way to trade and that it works. It doesn't. I see loads of people online analysing a 30-minute chart going backwards and they make money. I could do that. I could do it on a second chart, but the patterns are only obvious after the event, aren't they? They form randomly. So they're never going to make any money. The way to make money is to focus on the bigger time frames and stay away from the noise. And in terms of this, the turtles did it, and they focused on the bigger time frames, and they also focused on running big profitable trades as far as they possibly could without banking early. Okay, so they're focused on catching those really big winning trades, which I'll just return to in a moment. Now, in terms of catching big moves, okay, you can do it with small trade size. The turtles proved this. They also actually worked out the volatility of the instrument they were trading to get their stop right. Okay, and this is important because most traders don't do it. The stop should be dictated by the volatility of what you're trading, and then your trade size should be adjusted in light of the volatility. Now, in simple terms, all that means is if you've got, let's say, 100 pip stop to stay out the noise in one pair, and a 200 pip stop to stay out the noise in another pair, the one with the 100 pip stop could be double the trade size of the one you risk 200 pips on, if you, let's say, you decided to risk 2%. So your stop is dictated by the volatility of the market, and trade size is basically coming from the stop. What most traders do is they put on too big a trade size. That means they have to put the stop too close within the noise, and they end up losing. It's a big problem. Okay, now I say small trade size. What's small? My own view is you can make really great profits risking just 5% of your equity if everything goes wrong. I don't think you should ever go above 10% of your equity. Most traders are so keen to make money, they'll risk way too much, 30% of their account. I've seen people risk 50% of their account or more in one trade. It's ridiculous. Now, in terms of if you're doing small trade size and you're aiming for really big profits, you can lose a lot of trades. Okay, the percentage of winning trades is not important. The turtles realized this, that as long as losses were small and they ran their big profits, they could make a lot of money. And the turtles were winning 20 to 30% of their trades, losing 70 to 80% of their trades. But it didn't matter, they made great money overall. Richard Dennis, who developed the turtle trading rules, once said 90% of his profits came from just 10% of his trades. So the number of winning trades is simply not important. What doesn't change about the markets? Big trends persist, but, well, I've already alluded to this earlier on. The big trends are there, okay? And, they're there, but the noise is more than it was, perhaps, it is more than it was in the turtles' day, but you can still trade big trends. Now, in terms of trading big trends, I've mentioned it in a few videos recently, you can use very simple technical analysis, okay? But what you really need to do today is to work out the sentiment of traders behind the chart, because that will make your technicals very simple and effective. Now, in terms of sentiment trading, combining it with technicals, you can look up numerous videos we've done in our playlists on our channel. But if you take trading strategies, and let's take the turtle trading philosophy, you trade with an edge, you manage risk, and you be consistent. And they also said, keep it simple. Now, those beliefs are basically, I think, ones that all successful traders have. Trade with an edge. You must know what your edge is, okay? And you must believe that edge is going to work longer term. You must have researched it. Anyone trading for 50 pips, if you would actually research the logic of doing that and trading, let's say, off a 30-minute chart, you won't find any evidence to support that you can make money doing it, okay? But traders don't do that. They just take people's words online, or these strategy sellers who say it's easy to make small regular profits, and don't basically research the edge. You'll never hold big profitable trades unless you know the edge of your trading strategy and have rock solid confidence in it, because that's what you need to be able to keep your psychology under control when you're in a big profit. Okay, in terms of managing risk, we've gone through that. You never want to fall too far behind. You want longevity. All great traders or successful trading strategies have sound money management. Now, in terms of be consistent, you must be consistent and be disciplined. Okay, the turtles did this. They knew they were going to be losing the majority of their trades, but that didn't worry them. They knew the logic of the edge. They just kept going. They also were taught that, after you're in a really, sort of period, a long period of drawdown, very often, and I found this myself, it's when you're in those periods of drawdown that, you think, oh, when's it going to end? It suddenly ends and you start making money, okay? And I think, that is true from my experience. Now, in terms of being consistent, if you're in a period of drawdown, don't change anything. You just keep going. You keep being disciplined. If you start to, sort of change the way you trade or take impulsive trades or, change the way you do things, basically, you're not being disciplined anymore and following your strategies. You don't have a strategy at all. So you've got to be consistent. In terms of the turtles, they all make the point. There's a difference between simple and easy. Turtle trading rules, you can see them in PDF, incredibly simple. But they weren't easy for the turtles to follow, because obviously you do have that psychological problem with winning trades, running the big profits and accepting a lot of losers. The turtles, I think they could do it because, they were taught by Richard Dennis and Bill Eckhart, two trading legends. It'd probably be pretty easy to have confidence in them. Not easy, but to have confidence in what they were teaching. But your psychology just so important. The turtles, they did make a lot of money. They said it was simple, but it wasn't easy. And that's what I believe about trading as well. It is simple, but it's not easy. But you can make a lot of money by being aware of your psychology and managing it. And the way to manage it is to have a strategy with an edge you've researched and got confidence in. Then you can overcome the psychological problems of snatching your profits too early or wanting to take a bigger loss than you should, or deviating from your strategy or whatever. A lot to learn from the turtles. Like I said, the trading strategy won't work today as it worked back then because markets have changed. But the actual basics that were taught to the turtles can help you build a trading strategy that can help you make money. Okay. Now, in terms of trading strategies, like I said, we've got plenty of videos on combining sentiment with simple technical analysis to give a strategy which can make money over time. I think every trader will they'll look at other people's strategies. We look at all the great trader strategies, and then you basically build them into your own strategy. And every great trader, I'm going to stress this, has researched the logic of the strategy themselves. They know how it works, why it is going to work longer term. You must do that. Do not take anyone's word that a strategy works. You've got to do it yourself, because that's going to give you psychological control and discipline, which is essential in terms of making money. All right, that is the video for today. Thank you very much for watching me as per usual. Take care. Have a good day.